If you earn a high income or plan to, this video is for you. I'm going to cover the optimal order for investing, including a few controversial choices that will either make you glad you watched or turn away in disgust. Let's get started. Don't save cash, not yet. Most in the personal finance industry will tell you to save 6 to 12 months of cash before you do anything else. I think there's a better option. Pay down your credit card balances first. By doing so, this will achieve a few things that cash savings won't help you with. By paying your credit card debt off or getting below a 30% utilization, this will dramatically improve your credit score, and almost instantly. It's common to see a credit score jump up within 30 days after paying off a large portion of your credit card balance. Now you have a credit card with a spending limit that's most likely 2 to 5 times higher than what you could have stashed away in a rainy day fund during that same time period. You're also saving 15 to 25% in interest that you would have been paying on that debt anyway. Another bonus side effect of paying off your credit cards is the card provider itself won't likely lower your spending limit, like they would if you were to continually be running up against those high balances. Once your credit score improves, I'm going to recommend you do something that Dave Ramsey would cringe at the thought of.
The arrogance that is required, the intellectual arrogance that is required for you to think,
open a new line of credit. You must be crazy, Tom. Why would you do this? Well, the whole point of a rainy day fund is that you can continue if the worst case scenario happens and you aren't earning enough money. If you have thousands of dollars of available credit on either a card or a line of credit, then you can tap into those funds if needed. Bob Hope once said, "A bank is a place that will lend you money if you can prove that you don't need it." Good luck getting approved for a loan or a credit card when you actually need to. If you're planning to make a large purchase that requires low debt to income ratio, such as buying a home, then I definitely would avoid opening any new lines of credit until after the home purchase. So now that you've paid off your high interest credit cards and you continue to keep their balance paid off each month, we can move on to investing. The next step is to ensure that you have maximized your 401k employer contribution if they provide it. This is simple to do and basically provides free money. I'm sure you realize this and already know this. If your employer retirement plan offers a Roth 401k option, consider switching to this type of plan. Back in 2023, the Secure 2.0 Act enabled employees to designate certain matching contributions as Roth contributions. This means that both employee and employer contributions would be tax-free at retirement. So free money in, tax-free when taken out, win-win-win.
Win-win-win.
I'm a big fan of Roth IRA accounts, but if you're earning a high income, you probably can't contribute to one or contribute the full amount. In 2024, the Roth IRA income requirements are as follows. Single individuals making less than $146,000 can contribute up to the full $7,000. If you make $146,000 to $161,000, it will be a partial contribution amount, which is based on a calculation of your modified adjusted gross income. Make more than $161,000 as a single individual and you're out of luck. You're not eligible for the Roth, at least not through the front door, that is. More on that in just a minute. For married couples filing jointly, you need to make less than $230,000 to contribute the full amount. If you make more than $240,000, you're not eligible. So if you make too much money, are you completely out of luck? No. Just need to go to the alley, knock on the back door. A backdoor Roth IRA conversion is a strategy that allows individuals with high incomes to bypass the income limits for contributing to a Roth IRA. It involves making a non-deductible contribution to a traditional IRA and then converting that amount to a Roth IRA. This way the funds can grow tax-free and be withdrawn tax-free at retirement. The key steps are contributing to the traditional IRA and promptly converting it to avoid any significant tax liabilities on those earnings. What if you want to contribute more to a Roth? You just need a bigger door. You need a mega backdoor. A mega backdoor Roth IRA conversion is a strategy that allows high-income earners to contribute significantly more to their Roth IRA than the usual limits would allow. It involves making after-tax contributions to a 401k plan and then rolling over those funds into a Roth IRA. This process can bypass the income limits and contribution caps associated with traditional Roth IRA contributions, potentially allowing for tax-free growth and withdrawals in retirement. It's essential to have a 401k plan that permits after-tax contributions and in-service distributions to utilize this strategy. So check with your employer to see if that's eligible. Both the backdoor and mega backdoor Roth IRA conversion options are complex and is recommended that you seek financial advice from a tax professional. Remember, I'm not a tax professional, so find somebody that's qualified to help answer your questions. Another option for high earners is to open a solo 401k if you have a business with no employees. There are a lot of advantages of a solo 401k, including high contribution limits of $69,000 in 2024, no age or income restrictions. You can open a Roth or a traditional 401k, and a solo 401k can be self-directed. Self-directed IRAs open a world of opportunities, which I'll cover in a minute. If you're a solo entrepreneur like myself, you should look into a solo 401k. It's only fitting. Did you notice the solo 401k has no age restrictions? Interesting. I wonder if that means your children could have their own 401k account within your solo retirement plan. The answer is yes. I also wonder if there's tax advantages for the business. So now that you brought up kids, let's talk about saving money for their education and retirement. Back when I was a financial services professional, I sold a lot of 529 college plans. These plans allowed parents to build up education funds, which generally were free of federal and state income tax, if used for qualified expenses. The main issue with a 529 plan is it had to be used for educational purposes, or you'd be penalized if you withdrew for other reasons. The good news is that beginning in 2024, you can roll over unused funds from a 529 plan into a Roth IRA, but there are limitations. If you're interested in the key difference between a Roth IRA and a 529 plan for your child, I'd recommend visiting savingforcollege.com, as they have a great article on the topic. I'll leave a link in the description below. I prefer the flexibility of a Roth or a solo 401k account for my children if they choose not to go to college. Speaking of choices, now we need to discuss using a self-directed IRA account. A self-directed IRA is a type of individual retirement account that gives investors more control over their investment choices compared to traditional IRAs. It allows for a wider range of investments, including things like real estate, private equity, precious metals, and other alternative assets beyond typical stocks, bonds, mutual funds, ETFs, those kind of things. This flexibility can offer greater diversification and potentially higher returns, but also comes with some more complexity. If you're someone who likes to take control of your investments, then a self-directed IRA could be a great option. One example of how you could use your funds is being a lender to real estate professionals. There are many real estate investors that need funds to acquire fix and flips or bridge that gap between fixing a rental property and refinancing it into a more traditional loan. In most cases, you can lend your money at 10 to 12% interest and 1 to 2 points for 3 to 12 or even 24 months. Your IRA would be listed as the first position lien holder, so your loan is backed by the property. All the interest earned from that transaction would also be deposited back into the IRA and tax sheltered. Let's go through an example. Let's say Jerry, who's a seasoned real estate investor, finds a property that he plans to fix and flip. He's negotiated with the homeowner to buy the property for $400,000 and needs funding to purchase the home and renovate it. He estimates that the home could sell for $650,000 after spending approximately $100,000 on remodeling. You provide a loan for $500,000 from your self-directed IRA at 12% annual interest and 2 points. It takes Jerry 4 months to renovate the property and 2 months to sell the home. Altogether, you've earned $30,000 in interest, $10,000 from the points, for a total of $40,000 during that 6-month period. That's a 16% annualized rate of return that goes back into your IRA and can be deployed again. If your IRA is a Roth, then it would be tax-free at retirement. There are a lot of ways you can use a self-directed IRA, but make sure you work with a reputable custodian, as they're the ones who will be helping you out with navigating that paperwork. As a high earner, you're probably looking for some ways to invest that also provide tax advantages during your high earning years. This next investment is the Trifecta of Tax Savings. A health savings account, or HSA, is a tax-advantaged savings account designed to help individuals with high deductible health plans, HDHPs, save for medical expenses. Contributions to an HSA are tax deductible, the funds grow tax-free, and withdrawals from qualified medical expenses are also tax-free. HSAs can be used to pay for a wide range of medical costs, including deductibles, copayments, and prescriptions. Hence, the trifecta of tax savings. Unlike flexible spending accounts or FSAs, the funds in an HSA roll over year to year if not used. Additionally, after age 65, funds can be withdrawn for any purpose without penalty, though non-medical withdrawals are subject to income tax. The HSA contribution limits for 2024 are $4,150 for self-only coverage and $8,300 for family coverage. Those 55 and older can contribute an additional $1,000 as a catch-up contribution. Another way to potentially reduce your tax burden while also building your net worth is investing in real property. This could include real estate and/or businesses. If you purchase a rental property, for example, you could use accelerated depreciation to potentially lower your immediate tax burden. Accelerated depreciation is a method that allows property owners to deduct a larger portion of a property's value as an expense in the earlier years of ownership. This is how many wealthy individuals are able to have an income tax rate close to 0% because they're taking advantage of depreciation in real property. By maximizing deductions up front with accelerated depreciation, you can reduce your end-of-year tax bill significantly, which could help with saving more money in the long run depending on your investment and growth strategies. While we normally invest our income on a monthly basis, there are times when we find ourselves with large chunks of money that should be invested. This could include money from a divorce, insurance settlement, inheritance, or maybe you got lucky with the lottery. If you found yourself with a pile of cash and you aren't sure if you should use lump sum investing or dollar cost averaging, this video is one you should watch next.